Hi everyone, welcome to this month's Redwood Money Client Update. This month, I'm excited to share, as we head into the end of the year, a collection of some of the top financial planning tactics and strategies that I've used with clients to make their money work harder this year. There were a lot of themes that showed up in the process of delivering around 50 financial plans this year, and I wanted to share them with you both to recap some of the work that we may have done together so you could see that value and remember it, and also to give you a sneak peek at some strategies that we may not have implemented yet because they didn't fit your scenario, but may be in store for us in 2023 or beyond. Now, before I get into that, I did just want to take a quick break to say thank you. Coming out of Thanksgiving, there's so much to be thankful for, but as I think specifically about my business, I am just so grateful for you as clients that you've trusted me to manage your money. The business has far exceeded my expectations of what it would be at this point in the year. I'm over 50 clients. I've got clients in 5 different states. I'm advising on over $100 million of assets, and I'm really loving it. I love working with you. I love working now with many of your friends and family. And so for some of you, we have known each other for years, and I've been informally financial planning for you, and it's great to now be doing that formally and to really be walking alongside you and pursuing your goals. And for others of you, we just met this year, and I appreciate your trust. I love doing this, and I'm excited for what 2023 holds. Now, like I said, this month we're going to talk about these ways to make your money work harder. I hope that you find it helpful, and if you want to share it with someone else, I'm not going to have capacity probably until February or March, but feel free to share it with them, and I'll be happy to talk with them about their money. And finally, I'm going to finish up by talking about my 2023 goals and your 2023 goals. We'll talk a little bit about what our first quarter meetings will focus on so that you can be prepared for that. And I hope that in some of the moments where you slow down, hopefully at the end of the year, that you have an opportunity to reassess your goals, to celebrate some of the successes of 2022 financially and otherwise, and that this will maybe prompt some of those reflections ahead of our meetings. Now, before we get into these money moves, I just want to remind you that it's never just about money. Money isn't about pixels on a screen growing over time. Money is ultimately its life energy, as Vicki Robbins says. And many of you have seen this slide in our discovery meetings, that money is something you trade your life energy for. You sell your time for money. What we want is that non-renewable resource, that precious resource of time. And if I can help you be more efficient with your money, what I'm really doing is buying back your time for whatever you want to spend your one life and your life energy on. So that's what we're getting into. And I say that now because we're going to start talking about interest rates. And I know that can be boring. Remember the purpose, right? We're freeing up money for your goals and freeing up time for what matters. So here's the first one: how to make your money work harder, moving cash into high yield savings. This is really the first time in over 10 years that we've been above these non-zero interest rates for any extended period of time. And many of you, I noticed that we kind of got lulled to sleep during this period where Wells Fargo and Chase and Bank of America, many of these banks that we work with, they were paying us 0.01% interest on our money. And we were okay with that because the difference in switching to a high yield savings was maybe instead of 0.01%, you'd earn 0.25% or 0.5% on the high end. Well, now with the Federal Reserve increasing interest rates, the spread between what Wells Fargo is paying and, for instance, what Betterment is paying is absolutely enormous. So the monthly interest per $10,000, if you have that in the bank, on a Wells Fargo savings account is 8 cents. It's a rounding error. But Betterment, where I manage investments and where they have a cash reserve account that has $2 million of FDIC insurance for couples, you can move your money there in 2 days. You can move it back to your checking account in 2 days. They're paying 3.2%. So instead of 8 cents a month, you get $26.67 a month. This takes very little time, maybe 10 minutes to set up, and you can move money in there to earn more interest if it's earmarked for an emergency fund, for buying a home soon, for your kids' next college tuition payment. It is a great move to make. I included Star One here because they're a credit union and they're doing a pretty good job at 1.17%. But even there, you can be earning almost 3 times as much interest through one of these high yield savings accounts at Betterment, at Ally Bank, at Synchrony, and all of them will continue to compete for your dollars by being up around the higher end of interest rates. So you want to take full advantage of those. Now, on a different note, if you have a bunch of money in savings at Wells Fargo or elsewhere, but you're not paying down high interest debt, we absolutely want to make the trade. We want to take some of that money that's earning less, even if it's earning on the higher amount, like a Betterment cash reserve account, and we want to use it to pay off debt. So to use 2 examples I've seen, right? An unsubsidized student loan from 2009 that you're going to have to start paying on starting in probably September of next year. I think we might be at the end of the never-ending student loan deferrals. That's at a 6.8% interest rate. So your monthly interest on that would be $56.67. So we either want to refinance that debt to a lower rate, or we want to take that cash that's earning 3.2% and we want to move it towards paying off that debt. For variable interest rate debt like credit cards or home equity lines of credit, that has also been rising, the interest rates that you pay to have that debt. So we want to look closely at that. And the ultimate offender in this respect is credit cards. So Chase Sapphire Preferred just looked at this today. They're charging 26.7% interest on their debt. So if you have $10,000 of balances that you carry over month to month, then you are getting charged $222 a month or $2,670 a year in order to carry that debt. I want you to keep that money. I want you to have over $200. And so what we will work on together is finding ways to reduce spending, to move assets that are earning less, to pay off that debt, and to make sure that it doesn't pop up again. So that's the second idea to make your money work harder, is paying off that high interest debt, especially if you have cash on the sidelines that is earning less. Now, the third thing we want to do is we never want to have too much cash. Cash is great for everyday spending. It's liquid. It doesn't fluctuate in value. But over the long term, your cash loses purchasing power due to this thing that has reared its ugly head again, which is inflation. And inflation means that your money is steadily losing its purchasing power over time. It's shown in this chart, which looks at different asset classes or types of investments over the 90 years or so from 1928 to 2020. And what you can see here is that 1 month T-bills, which is basically a proxy for savings accounts, $1 grew to, it actually grew to $15 in that account. But inflation meant that if you wanted to spend $1 worth of, buy $1 worth of goods in 1928, to buy that same amount of goods in 2019, you needed a $20 bill, right? So what do you need to do in order to make sure you can buy more in the future with the dollars you have now? We need to invest those dollars. We need to invest them at a rate that is probably higher than what cash can give. And thankfully, there are other investments that have historically outpaced inflation and outpace what cash will pay. So 3 examples on here. This yellow line is bonds, which are debt investments, and these are long-term government bonds. Those grew from 1928. $1 would have grown to $149. So you beat inflation, you increased your purchasing power, and you were just lending money to the government, which can print the money, so they're going to pay you back. Very low risk, you notice, doesn't fluctuate as much. These other 2 investments are stock investments. And yes, you're taking more risk, but notice the reward here. It is incredible how much wealth has been created through investing in businesses, which is what a stock investment is. And so this is large cap stocks. That's the S&P 500, the 500 largest companies in the US. If you had invested in an index of those, your $1 went up 6,000 times to $6,020. And then these are value stocks, large value stocks at $17,219. We don't need to get into the technical details of that, but we don't want you to have too much money in cash sitting on the sidelines, losing value to inflation if it's money that you don't need near term. That is why we invest. We right size your cash position, and that is a huge way to make your money work harder so that over the long term, no promises about the next 6 months, 1 year, 2 years, but over the long term, you are best positioned for growth in your wealth. All right, the fourth thing that we're going to do that will help you to stick with that plan is we're going to make your money work harder by automating those good decisions. So this is an example of a money tree, which I create for all of my clients. It is a way of mapping the flow of money in your life. And as many of these decisions as we can, we will make automatic. Why do we do this? Well, think about the bills you pay. They always want to make them automatic so that they get paid. Think about your taxes, right? When you earn money at a W-2 job, you don't even see the money that's going to the California government and the federal government. It just comes out before you ever see it. They automate it so that you don't have to have the discipline because they know that's how you get paid. Well, why wouldn't you be just as intentional with your own personal decisions to save? When you're paying yourself, if you're paying yourself first, you want to make sure it's automatic. So we'll route some money out of your paycheck to tax-advantaged accounts like HSAs, to 401ks, maybe an employee stock purchase plan. Even after money lands in your checking account, now with technology, it's so easy to route some money to your emergency fund, to a 529 for kids' college, to IRAs, and to brokerage accounts. By automating all this, it's like eating your broccoli first, and then you can spend what is left over guilt-free. And that helps you to be much more efficient in your savings and your investments. The fifth thing we'll do to make your money work harder is we want to max out tax-advantaged accounts. So to use an example of a family maybe making $200,000 a year, one of them has access to a 401k plan, and they're putting in the maximum for 2023, $22,500. Their employer is matching that contribution at 3%, so there's another $6,000 that goes into that account. They're also maxing out an HSA, and they're covered, their spouse is covered, their kids are covered, so they can put in $7,700 a year. So their pre-tax contributions are $36,000 per year. What this means is that off of that $200,000, first of all, they don't get taxed on the match that the employer provided. So that goes in pre-tax and it grows, and they'll only pay tax on it after it comes out in retirement. But the other $30,000, that also doesn't get taxed. So instead of being taxed on the $200,000 of gross income, they'll be taxed on roughly $170,000 before taking into account other deductions. That reduces your tax bill. And that money that didn't go to the government gets to grow tax-free, and you'll only pay income tax on it when you take it out in retirement. Really strategic and a much better way to save and invest that the government wants to incentivize because they want us to do things like retire or be able to pay for our healthcare or be able to pay for education expenses. Now, there are other accounts that you can put in money after tax. And typically the way these function is you put in money after you've paid tax on it, but then it grows tax-free and you can take it out tax-free in retirement. A Roth IRA or a 529 for education functions this way. So let's say you have a 1-year-old. You put $10,000 this year into their 529 account. And then 18 years from now, they go to college and that $10,000 has grown to $35,000. And you can make half of one semester's tuition payment with it. But you take that $35,000 out of the account. You send it to the institution. The government will not charge you taxes on that money that you grew. The $25,000 of gains is tax-free because it was what that account was created for. Same with a Roth IRA. You put in $6,500 now. It can grow to many multiples of that value. And when you take it out in retirement, you want to not pay taxes on it. That's how the Roth functions. So wanted you to see these as an example. It's not a specific example for a client, but I often see that people don't know how these accounts work. They don't know the appropriate mix based on their goals, or they're missing out on free money. I'll talk a little bit more about that later, that their employer would give them because they just don't know how it functions, or they're concerned about accessing the money, all these different things. We want to make sure you're taking full advantage of these based on your goals. Okay, the sixth way to make your money work harder. This one gets me pretty frustrated because one thing I will say about the investment management industry, the financial industry, is I think there are many advisors who have become comfortable charging what I think are exorbitant fees and not delivering much value. And so there are often ways that you can reduce management fees on the money that you have invested at a 401k, with your advisor. Even if you're self-managing, there are ways you can reduce fees. And I think of fees in a few big categories. There's fees you pay to an advisor, custodial fees that you pay to the places where you have your money managed, and then fund fees if you have your money in mutual funds or exchange traded funds that everybody pays. So for advisor fees, right, these could be commissions that are paid to an advisor who's really a salesperson, who's putting you into mutual funds or insurance products or annuities. I don't ever charge commissions. I'm only compensated by clients, but many advisors, they work this way because that's how their company compensates them. You want to know what those fees are. Sometimes it's 2%, 5%, 10% of the money you put into a product goes straight to the advisor. That money doesn't grow for the future. It just grows in their bank account. So you want to know what those commissions are and what the incentives of your advisor are. Now, there are other advisor fees. There are two that I charge. One's financial planning fees for advising on your entire balance sheet. And the other one would be asset management fees. If I'm managing an IRA or a brokerage account or a trust account for clients, I charge 0.6% per year on the assets I'm managing. So if I'm managing $100,000, it's $600 a year that I charge to manage that money for you, to choose the investments, to make sure that we're putting money in, that we're distributing it, that we're doing required minimum distributions. All of the management I take care of, and I charge a fee for doing that. Now, what I've seen in this year of doing financial planning is there are many people who don't know what they're charging, who are very surprised when they find out what they are being charged. So I've seen advisor fees where somebody thinks they're paying 0.75%, but when you add all this up, they're being charged 2% or more. And that is just a huge amount of money to have coming out of your accounts, going to someone else. It's not just that you lose the money that you pay in fees. It's that you lose every single dollar that dollar of fees would have ever earned when you pay it. It's gone forever. So you want to make sure you know what you're paying and you're getting value for what you're paying. And my hope as an advisor is that I am always creating multiples of value for the fees that I'm charging for my clients. And it's something that you should be able to quantify as a financial advisor. All right, off my high horse there. Okay, probably angered some people with that. All right, seventh one, risk appropriate investment mix. Now this one it's a little bit more slippery, but I will say that I've seen this year people who are young, who should be invested aggressively, who have the bulk of their money in cash. And I've seen people who are on the verge of spending money and they've got it all invested in really aggressive investments and it's very vulnerable to losses. What we want to do is make sure that your money is in the right buckets based on your goals. So what you'll see from this chart, this example, is money growing from 1976 to 2020. And of course, if you have higher stock exposure versus bond exposure, you end up with more money. So if you have a bunch of money in cash and you're in your 20s and you don't have a goal for it, we want to invest that, and we can probably invest that pretty aggressively. But conversely, if you have a bunch of money that you've set aside for buying a home and it's all in your company stock, we probably need to sell that stock and have it set aside for buying that home. So we want the right investment mix for you in each of the different buckets of money that you have, and that's one way to make your money work harder, either by being more conservative or more aggressive. The eighth one is structuring a tax-advantaged income strategy, both as you're accumulating and as you are spending down your assets. So this is a screenshot from a sample plan inside of my financial planning software. This is for John and Sarah Sample. You can see here that at age 38, in my proposed plan, they would pay $55,000 of federal taxes. But in their current plan, because they're not taking full advantage of 401ks or HSAs, they'll be paying $63,000 in taxes. This $8,000 of tax savings then gets to grow for the future. The net of all the tax planning over their lifetime from 38 to age 90 is that they are going to save $263,000 in potential taxes. Now, this has assumptions about future tax rates, but each year we want to look at your plan and make sure that we are optimizing how much you're paying in taxes by pulling different levers on savings, on deductions. This is a really important way to make sure that you keep as much as you legally can of your dollars, and that as they grow for the future, hopefully you end up with more assets. All right, the ninth one, again, I hope I'm not putting you to sleep with this tax conversation, but the fact is, even when you look at an account balance, if that money is in an account that's going to be taxed, you don't get to keep all of it. So we want to, at every single point in the financial planning process, think about taxes. What does this look like? Well, we're going to be really tax aware with any contributions and distributions we make, putting it into tax advantaged accounts, looking at selling stock and thinking, for instance, with company stock, if you got stock that vested 16 times over the last 4 years, which are the right shares to sell to be smart about which ones we're paying taxes on. We want to make sure that we're not trading too much and incurring capital gains or capital losses. Speaking of capital losses, we might be doing some tax loss harvesting inside of your accounts, and we've done a lot of that this year. Using Roth conversions to pull forward taxes and to smooth out your tax rate over your lifetime. And then asset location is just a way of saying being tax smart about which money is in which buckets. All of these things are things that I'm thinking about for clients and that are built into your financial plan so that when you're taking money out of these investments or putting it in, we're being smart about the present and future tax consequences. All right, 10th and finally, optimizing employee benefits. Now, this doesn't apply to everyone, but for many of you who have a W-2 employer, there are incredible benefits that are available to you if you know how to take advantage of them. This is an example of NVIDIA's benefits. This isn't any specific client, but at NVIDIA, if you contribute $12,000 a year to the 401k plan, they match you to $9,000. If you're enrolled in a family health savings account, the limit's $7,750 per year, they'll put in $3,000 for you to incentivize you being in that plan. They also have an employee stock purchase plan, which allows you to buy at least $25,000 of stock for $21,250. Now, there's limits in what percentage you can save, but if you're making enough, you can put this much money away and have at least $25,000 of stock that you purchase in 2 separate purchases over the course of the year. And if you have student loans and you graduated in the last 3 years, for up to 5 years, they will put $500 a month or $6,000 a year towards your student loans. What this means is if you put away $33,000 a year, your match or employer contribution to these different accounts is $21,750. What's so cool is that 401k money can grow for the future. The HSA money can be invested. You can hold on to the employee stock purchase plan or you can sell it. The net of all of this is an NVIDIA employee who knows how to take full advantage of their different employee benefits. It's like having an additional $22,000 of compensation. For somebody who doesn't, they might be leaving that money on the table. And I've seen each of these different categories with various companies, people who are not taking advantage of the benefits. And those can be $5,000 conversations that we have when we find ways to take advantage of them. So take a close look. This is why we look at open enrollment at your benefits and we look at how to take full advantage of them for you. So those are the 10 ways that you can make your money work harder. Again, notice we didn't talk about earning more. We didn't talk about spending less. This is with money that you already have, just being more efficient in each area of your financial plan. Okay, looking ahead to 2023, what can you expect as we head into the first quarter? First of all, we're going to celebrate 2022. Many of you accomplished awesome goals. You hit new net worth milestones. You bought a house, you paid off debt, you had a child. There were all of these different things that we want to look back and celebrate. Even things like maxing out a Roth IRA for the year, that's something to celebrate. So we'll look at what we did, and then we will look ahead to the future. We'll update your profile with any changes. You can log into Right Capital right now, and if your income changed or if there was a job change or an address change, we want to update all of those things so that your plan reflects accurately. Then we'll reassess your goals. I think it's so important to look at the end of a year to say, what did I think that I wanted next year? To reevaluate that and to set a new trajectory if you need it, or to reaffirm that that's what you want. So we'll take a look at your goals, any new things that have come up, and embed them in the plan and make sure you're still on track. Then we'll set savings targets. So we're going to rebuild your money tree. It'll probably be fairly similar to what you had last year, but we'll make sure we've got the new 2023 contribution limits. We'll log into your 401k and other providers and make sure you're saving enough. And we'll do that early in the year so that you're on track over the course of the year. And fifth and finally, we will prepare for taxes. If there are transactions that we did throughout the year, like selling stocks, tax loss harvesting, Roth conversions, we will take a look at those things and I'll make sure that your CPA knows about them so that we're prepared for taxes and we don't miss anything. Now, I did tease that I have a non-financial goal that I wanted to share with you, and that is that in 2023, May 13th, I'm going to be running a 50K, which is a 31-mile race. I'm very excited, and pretty nervous about it. But the reason I'm doing this is, one, I just wanted to kind of up level my fitness. And for me, just the idea of running 3 miles a day has no excitement. But if I know that I've got some big goal ahead of me, it motivates me to actually train. So I've started training for that, and I'm building up to that distance. The second thing is, so much of financial planning is having the mindset of a marathoner. It's not a sprinter's mindset. And I just watched on Netflix the documentary Eat the Rich, which is about the GameStop phenomenon and the stock going up to the moon and then falling back down. And a lot of people think that that's what financial planning is about. It's about finding the next GameStop, finding the next Bitcoin. The fact is, good financial planning is about making smart decisions month after month and year after year, and keeping your splits, hitting your splits on an ongoing basis, making sure that you can actually accelerate into the finish line and you don't run out of steam. So my hope is that as I pursue this race, it makes me better in a lot of areas of life, but I also hope that it'll make me a better financial advisor as I kind of embody that long-term marathon mindset and hopefully pass it on to some of you. Also, now I have to do it because I told all my clients. All right. So what's next? If you want to connect between now and year end, we've got a couple of weeks left of meetings. Go to redwoodmoney.com. You can schedule that meeting. If you want to access your financial plan, you can do that at Right Capital. Your investments are at Betterment. If you have any questions, text me at 408-617-8757. Early next year, I will be sending out an email to schedule our January or Q1 meetings. Stay tuned for that. I look forward to connecting with you, if not before the end of the year, in the new year. Happy holidays to you and your family. And again, thank you so much for being a client.